Hi guys, Wade Curtis from Curtis Property Group here. Trust you're having a wonderful Friday and looking forward to the weekend. Just before we do shoot to the weekend, I just want to answer a lot of questions that I've been getting in terms of interest rates and why some banks are actually increasing the interest rates when the Reserve Bank haven't actually increased theirs. So great question, and I want to answer it for you. Essentially, what it is APRA are a regulator for our banking systems here in Australia, and they oversee the banks to make sure they're staying compliant and they're not becoming overexposed in any particular sector. So, for example, the investment sector in Brisbane or in Sydney and Melbourne has been quite excessive over the last few years with the housing boom that's been going on there. So some of the banks have been lending heavily to the investment sector in those markets, and it's pushed them above their 10% allowance of growth per year. So if they increase their loan book, their investment loan book, in excess of 10% per year, APRA clamp down on them, tell them to cool it, and what they do is effectively push business away. And how do they do that? They put up interest rates. They adjust their servicing rates for your ability to actually get a loan and being able to fund it and service the loan. And they also modify their loan to value ratios. The amount the bank's actually going to lend you on a particular asset, either 80% loan to value ratio, 90%, or even 95% LVR, loan to value ratio. So that's how they can restrict you from being able to borrow money. So they're trying to push you away so they don't grow their loan book. It's crazy as it sounds, but this is all the stuff that goes on behind the scenes. It's not just because they want to lift their interest rates. They've actually been told by Big Brother, essentially. So that's how it works and why all banks are different and they have different products, different servicing ratios. It all hinges on their leverage of their loan book and their investment loan book, and that's why they're doing this. I hope that clarifies a few things. It's typical of our Australian banking system, and it's not a bad thing because it keeps us nice and safe and secure. We don't want to be like the US was, back with the global financial crisis, where they were lending a lot of money to people that couldn't even afford to pay those loans back. Here in Australia, if you borrow money at 4.5%, they're actually assessing your ability to pay that money back at potentially 8 or 8.5%, in some cases 9%. So we're nice and safe here, which is not a bad thing. I hope that clears a few things up, but have a fantastic weekend. If you've got any particular questions or any topics that you would like me to focus on next, please email me at info@curtispropertygroup.com.au, and I'm happy to explore different opportunities and different topics and bring them to the table. Thanks guys, and have a great weekend.